Hey everyone! Welcome to the Unit 1 AP Macroeconomics review, where I'm going to go into the first aspect of Unit 1 of AP Macroeconomics to help you out when you're studying. Now, the most important part of the entirety of macroeconomics for AP exams is GDP, which is gross domestic product. And what this is it's used to measure the health of a certain economy, typically the health of a different nation's economy. And this is essentially the dollar value of the final goods and services produced in a country in a given year. Now, it's very important to understand a couple aspects of that sentence. The first one is its dollar value, which means it's not expressed in terms of the actual kinds of goods. It's not the number of chickens. It's not the number of hot dogs. It's the dollar value. Then there's final goods and services produced, which means that it focuses on goods produced. Meaning, if I have an inventory worth $100 of, let's say, hot dogs, and I only sell 5 of them, all 100 contribute to the GDP. Make sure you understand that. Then it's also within the country, meaning if you're in America, you only count goods that were produced in America. You do not count exports. And the other part of the sentence was per year. And because GDP is used to analyze the health of a place's economy, we want to do this over the span of several years. And so in order to do that, you need to take one every single year to compare and contrast. So it's important to make sure that you understand that it's taken every single year on an annual basis. If I told you that we needed to measure every single toothpick that was produced this year, it would be a pretty Herculean task. And that's why when it comes to GDP and measuring the things that we've produced, there are methods and manners to actually tracking it efficiently. The first one is going to be the expenditure approach. Now, the expenditure approach is basically tracking all the transactions and expenses made by different parties in an attempt to actually understand all of the goods and services that were produced in a certain year. Now, first to understand that, we need to know the 4 parties that are considered within the people that have the ability to purchase items or services within a certain economy from the expenditure approach. And that is first households. Now, households make up over 70% of all the expenditure in the expenditure approach, and these are, households, they're individuals, they're consumers. The second category is investment spending. And investment spending basically encompasses all the business investments that are made. But the use of the word investment is different in economics than it is in places like finance or business. Because investment isn't things like stocks or shares, but it's rather things like the products that are invested in for the inventory of the business, or maybe rental investments for the business. The third party that has the capacity to purchase in this economy is the government. This means all sort of federal spending, all sort of national spending, even global spending. On a government level, it would be considered government spending. Now, the last section would be net exports. And it's important to remember that a lot of the goods produced in a country actually end up going to other countries because they were produced here, but they are exported to other places that need them as well. Now, it's important to remember as well that these are net exports, meaning that it's exports minus imports. And the reason why imports aren't considered in the GDP is because they weren't actually produced in that nation's economy. They were imported from another nation's economy. So after considering all 4 of those parties, we get single-handedly the most important formula in all of macroeconomics. And that is GDP equals consumer purchases plus investment by businesses plus government spending plus net exports, which is represented by X. And remember, net exports is exports minus imports. The second method of calculating GDP is the income approach. And basically, the income approach is collecting and compiling all the different income and money earned by different parties, like firms or households, as a method of calculating everything that is being produced. So the most common form of income is going to be wages and salaries, but there's also a lot of other ways. And really everything around us, everything that is produced is just a compilation of different incomes, whether that's a toothpick, whether that's a hamburger, whether that's a toaster. Let's take the toaster, for example. If a toaster retails for $15, let's say 6 of those dollars went towards paying the people who made the toaster, so labor costs. And then 4 of those dollars went towards the raw materials from that toaster, so the metal or the wood. And then 1 of those dollars went towards actually paying the overhead in producing that toaster, so let's say the rent of the production facility. And then the rest of the $4 are the profit. All of those different aspects of the cost of the toaster and the final value of the toaster actually are derived from different people's incomes. So the labor cost goes towards someone's wage or someone's salary. The raw materials goes towards the raw materials company that someone purchased it from. The overhead expenses go towards the utilities company. And the profit that was earned off of that one toaster goes directly towards the retail store. So really everything that we have and every single product is derived from a bunch of different incomes, and the value is derived from a bunch of different incomes. The final method of calculating GDP is essentially the value-added approach. And what that is as something moves through the different steps of the supply chain, a certain amount of money or value is added to the product. So let's take the toaster example again. There's the raw materials for the toaster. That would have a specific amount of value to the toaster. Then there would be another company or another party that ships it to one place. More value is added through that. And then let's say another company packages it all up. Then more value is added. And maybe let's say the final company markets it out and puts it in retail stores. More value is added. So as a product increases in value, it also increases in monetary value. And we can finally get the final value of each good or services produced in a certain economy. But now that we know how to calculate the GDP, it's also important to understand the inevitable limitations of the GDP. And there's actually trillions of dollars of goods and services that are produced every single year that aren't accounted for within the GDP. That's called the underground economy. Now, the first part of the underground economy is all the illegal goods and counterfeit goods that are produced. Those technically aren't counted, even though they are part of the economy. The second one would be all of the goods and services in the household underground economy. Let's say I need to buy food, and usually I'd go to the supermarket to buy food, like Walmart. But instead, I open my own garden backyard, and I start producing my own food in my own garden. Technically, there's almost no way of accounting for that within the GDP, and so it's just not calculated for. And actually, the underground economy from households is estimated to be 30% of the official GDP if it were to be calculated for. So there's a huge amount of goods that aren't accounted for every single year that are actually produced. So we talked about the underground economy and how a lot of goods aren't considered in the GDP, but they should be. But there are also a lot of goods that aren't considered within the GDP, and they shouldn't. And these examples can be used in the acronym SIP. The first part of SIP is secondhand sales. And basically what that says is that we should not count goods that are secondhanded sold in our GDP. Because when I sell my old t-shirt, it wasn't produced again. I'm just reselling the object. We also have intermediate sales. And basically that's like, for example, if I have a popsicle, there's the actual popsicle, and then there's the popsicle stick. I shouldn't recount the popsicle stick as a new good produced when it was already produced when I bought it from the person selling me the popsicle sticks. So we don't want to double count anything, and that's the reason why we cannot count intermediate sales. And finally, it's purely financial things. So let's say stocks or shares or all those purely financial transactions and assets. Those shouldn't be counted because they technically aren't produced. But GDP can actually be calculated in ways and rearranged in ways that make it more effective. There's two main ways to do this. The first way is per capita GDP, and the second way is real GDP. Real GDP is basically where we take GDP outside of inflation. Because let's say I produce $200 of goods and services in dollar value in 1 year, and then the next year I produce $220. Now, while that may seem like there was more production because that's the entire purpose of GDP in the first place, it could easily just be an increase in inflation, which means that the prices of goods in general just went up, and the actual amount produced didn't really change. And that makes the entire GDP redundant in the sense that it was made to actually measure the amount of goods produced, not the increase in money that each thing costed. And so, as a result of this, we have the GDP, real GDP, which basically takes 1 year as the base year. So let's say in this example, in 2019, pizzas costed $10. There were 4 pizzas produced, and so the value of all the pizzas produced was $40. If you look over here, when we use real GDP in a base year to evaluate in 2020 how much was produced, we go 5 pizzas times $10 instead of the $11 actual value, because we know that technically that would just account for inflation if we do 5 times 11 equals 55 instead of 5 times 10 equals 50. It's just an attempt to get a more accurate reflection of GDP. The second type of GDP is per capita GDP. And like real GDP with inflation, per capita GDP accounts for population. And this is important because we have to consider GDP is used as a method of evaluating the health and productivity of an economy. So if we want to do this, it's also important to understand the population and the available resources and capacity of that economy as well. And let's take the example of Montana, the state, and Japan, the country. Japan produces over 145 times more than what Montana produces. So technically it should have a much, much higher GDP than Montana. But it's also important to consider that the population of Japan is immensely larger than the population of Montana. And so what we do to accurately compare the two in terms of production and the efficiency of their production is we take the GDP and divide it by the population. And by doing that, we can see that they actually have very, very similar GDPs. In fact, they both have GDPs in the 40,000s. And so because of that, because of per capita GDP, we're able to actually analyze and compare countries in a more accurate light. If you've made it this far, that means that you've completed all there is to know pretty much about the GDP in terms of Unit 1 for AP Macroeconomics. You've learned about the different parties involved in GDP, the most important GDP formula. You've learned about the 3 different kinds of methods to calculating GDP, the limitations and benefits of GDP, and also things that are included and not included within the GDP. Now that you understand all of this, it's important to check out the other units for more understanding of GDP, and also check out some of the other resources I've provided in the description.